Topic introduces the defining features of corporate issuers and explains how businesses are organized to raise capital, conduct operations, and create value for stakeholders. Corporate issuers are legal entities formed to engage in commercial activities and are central participants in financial markets. The topic explains how firms differ in ownership structure, legal liability, governance, financing capability, and taxation. Understanding corporate issuer characteristics is important because organizational structure directly affects operational flexibility, access to capital, risk exposure, and long-term profitability. Investors and analysts evaluate these features carefully when assessing financial performance, strategic positioning, and the overall investment attractiveness of a company. The topic begins by discussing the primary forms of business organization: sole proprietorships, partnerships, and corporations. A sole proprietorship is owned and operated by a single individual who retains all profits but also bears unlimited personal liability for business obligations. Partnerships involve two or more owners sharing profits, management responsibilities, and liabilities according to partnership agreements. Corporations differ significantly because they are separate legal entities distinct from their owners. Corporate shareholders generally enjoy limited liability, meaning their financial exposure is limited to invested capital. This separation between ownership and management enables corporations to grow more efficiently and attract larger pools of external financing from capital markets. Limited liability is one of the most important features of corporations because it protects shareholders from direct responsibility for corporate debts and legal claims. This protection encourages investment by reducing personal financial risk and allowing investors to diversify across multiple companies. Corporations also possess continuity of existence, meaning the business continues operating regardless of changes in ownership or management. Shares can generally be transferred easily through public or private markets, increasing liquidity for investors. These characteristics make corporations particularly well suited for large-scale operations requiring significant capital investment. However, corporate structures may also create agency problems because managers may pursue objectives that differ from shareholder interests. The topic also explains how corporations raise capital through debt and equity financing. Equity financing involves issuing ownership shares to investors, providing permanent capital without repayment obligations. Shareholders may benefit through dividends and capital appreciation but bear residual business risk. Debt financing involves borrowing funds through loans or bond issuance, requiring regular interest payments and eventual repayment of principal. Debt financing may increase financial leverage and enhance shareholder returns during profitable periods, but excessive leverage increases financial risk and bankruptcy probability. Analysts evaluate a firm's capital structure carefully because the balance between debt and equity affects profitability, liquidity, cost of capital, and overall financial stability. Corporate governance is another important topic within the topic because it influences accountability, strategic decision-making, and investor confidence. Corporate governance refers to the system of rules, practices, and oversight mechanisms used to direct and control a company. The board of directors represents shareholders and monitors management performance to ensure decisions align with shareholder interests. Effective governance promotes transparency, ethical conduct, and efficient resource allocation. Weak governance may lead to conflicts of interest, excessive risk-taking, fraud, or poor strategic decisions. Investors often consider governance quality when evaluating companies because strong governance practices can improve long-term performance, reduce operational risk, and enhance market valuation. The program further discusses stakeholder relationships and the broader responsibilities of corporate issuers. While shareholders are residual owners of the firm, corporations also interact with employees, customers, suppliers, creditors, regulators, and local communities. Successful firms balance stakeholder interests while pursuing sustainable profitability and long-term growth. Environmental, social, and governance (ESG) considerations have become increasingly important in evaluating corporate behavior and strategic decision-making. Companies that manage stakeholder relationships effectively may strengthen brand reputation, operational resilience, and competitive advantage. Analysts increasingly incorporate stakeholder and ESG analysis into investment decisions because these factors can influence risk exposure, regulatory outcomes, and long-term financial performance. Another key feature of corporate issuers is their ability to pursue strategic growth opportunities through investment, mergers, acquisitions, and international expansion. Corporations can access large pools of capital through stock and bond markets, enabling them to finance research and development, technological innovation, and expansion into new markets. Public corporations often possess advantages in scale, operational efficiency, and financing flexibility relative to smaller private firms. However, larger organizations may also face challenges related to bureaucracy, coordination, and agency costs. Analysts evaluate strategic initiatives carefully because growth opportunities influence future earnings potential, competitive positioning, and shareholder value creation across different economic and industry conditions. Overall, Topic provides a foundational understanding of how corporate issuers operate within financial markets and the broader economy. Organizational structure, limited liability, capital raising methods, governance systems, stakeholder relationships, and growth strategies all influence a corporation's financial performance and investment characteristics. Corporations play a critical role in economic development by mobilizing capital, creating employment, and driving innovation. For CFA candidates, understanding the features of corporate issuers is essential because these characteristics affect valuation, risk analysis, capital structure decisions, governance assessment, and long-term investment performance.